From a statement perspective for the next year, what would the money markets take away from? What would make you believe that the money markets, both the bond and the rupee markets, would be happy with? And what is it that might worry them?
So I think what bond markets will be kind of happy with or relaxed with is just no unpleasant surprises. I think bond markets have internalized the fact that we're going to get a 0.5, 0.6% of consolidation. There's a 2% of GDP consolidation for the next 3 years. There is a belief that maybe there's a little bit more borrowing that could happen for this year, because even if you stick to your deficit of 6.4%, it's of a larger denominator. Nominal GDP this year will be higher, but that's also something bond markets have internalized. To be fair, Neeraj, bond markets borrowing costs are actually much lower. Remember, last year everybody fretted about how would all of this borrowing go through if the central bank could not buy bonds. Credit growth picked up and everybody was really worried. But if you think about real GSEC yields, right? So we have to think about GSEC yields, but deflate them by core inflation. They used to be 2.5% pre-pandemic. They're now 1%. So despite the fact that deficits have been larger, and the borrowing has been higher, the bond market has absorbed this very well. Part of it is because, to be fair, state borrowing was lower. Part of it is because we are seeing much greater demand at the long end by insurance and pension. Non-bank sources has gone up very sharply. And part of it is because, a corporate capex cycle is still going to take time. So the government can afford to run larger deficits without necessarily crowding out. So I would say from a bond market perspective, real bond yields are very comfortable. If there are no large unpleasant surprises, which I don't foresee in terms of deficit numbers and borrowing numbers, I think the borrowing program should go through, without any incident in the coming year.